So one of the most common challenges that business owners face is how do they keep their business and personal finances separate? And this is especially challenging for when you're just starting out in business. So that first 12 to 24 months, that 1 to 2 year mark. And it's really hard to not only start a business, run a business, grow a business, but along the way, you need to understand and try and separate as much as possible. Money is yours to keep personally. Like how much can you take out of your business and pay yourself as a wage for groceries and rent and mortgages? How much money do you need to actually leave in the business, and what business expenses do you have? So business overheads, costs, staff wages, that type of thing. And then most importantly, how much money do you need to withhold or keep aside for the tax man? So if you're doing your tax on a yearly basis, how much do we need to actually keep aside so that you don't end up with a big tax bill? So in today's episode, I'm going to share with you a real client scenario of some clients that I've been working with for a number of years that when they first came to see me, they were facing this exact problem. I'm going to take you through what we were able to achieve by working together, as well as what their current financial position was when they first came to see me, the things that we did and what we put in place and what we were able to help them with. And then what were some of those big results or big lessons that those clients were able to learn.
Welcome to More Than Money with your host, Ross Marais. This episode of More Than Money is brought to you by More Time Financial, a financial planning company who are on a mission to help young Australians make smarter decisions with money by providing real-life financial advice, coaching, and financial education.
Hey, what's up? It's your host, Ross Marais. Welcome back for another episode of More Than Money. This is a podcast for people who like to do things differently, who aren't willing to settle for what society expects of them. And on this podcast, I have real conversations about lifestyle, money, and business. Sometimes I share interviews with young business owners and entrepreneurs, as well as financial education and informational episodes to help you make smarter decisions with your money. So if you're new here, please consider subscribing. So this is the story of Kim and Kanye West, some clients of mine. Obviously, I think it goes without saying that I've had to change the names for privacy reasons. I'm not actually working with Kim and Kanye West. However, looking at their situation and what's happening with them at the moment, it would be very fascinating to have them on as clients and be dealing with a divorce of that size and trying to separate their assets. I think it'd be pretty fascinating. So these are clients, Kim and Kanye West, that I've been working with in my business, More Time Financial, which is my financial planning business. And what we were able to achieve by working together was initially we're able to increase their savings by about $12,000 a year, so about $1,000 a month, which was massive once you understand what their current financial position was or their starting financial position was. And then we were also able to go from being $20,000 in debt to having a house deposit of $50,000 and purchasing their first home within less than 18 months, which was pretty amazing. So before we jump into today's episode, of course, this is all general information, and this was the advice and suggestions that we worked through for these clients after getting to understand their entire financial position. So this was over about 2 to 3 meetings, plus a number of hours spent researching their current financial position before we came back and made these recommendations. So please do not take this information and apply it to your own financial circumstances without first speaking to a licensed professional, because it may or may not be relevant for your personal position. So what I'm going to go through now is just to give you a bit of backstory of what their current financial position was, or what their position was when they first came to see me. And then I'll get into a bit of the details of how we're able to help them increase in year on year. So it started off relatively small, and then it's just been year on year has been growing and starting to go really well. So they have a combined income of $150,000 per annum, which is about $10,000 a month after tax. I won't get into too much detail on the tax side of things. Combined expenses of approximately $9,000 a month, which means that they were saving about $1,000 a month or $12,000 per annum at the moment. They're renting, and they had total assets. So assets are things like savings, superannuation, cars, shares, property, that type of thing. So they had total savings of about $80,000, and that was $60,000 in savings, a little bit of money in super, so about $10,000 in superannuation, a car worth $10,000, and just I think an important side note on that, in regards to superannuation, this is something that I see a lot with self-employed clients or business owner clients. Because it's optional whether they pay themselves superannuation, if they're a sole trader or just getting started and not an employee of their business, it's optional whether they pay themselves superannuation. However, if you're an employee of a company, by law, your employer has to pay you superannuation. So this is something I see a lot, that because they're self-employed and cash flow is tight, they neglect to pay themselves superannuation to try and fix that short-term need. So this was the case with Kim and Kanye. They had about $10,000 sitting in superannuation. They had total debts of approximately $20,000, and that was made up of a car loan, credit card, and ATO debt. Because they hadn't been withholding the appropriate amount of tax each year, because their finances were a bit all over the place, they had built up a tax debt. So their net position or net worth, if in the financial world we look at your total assets, in this case $80,000, less your total debts or total liabilities, and of $20,000, so that gives us a net position or net worth of about $60,000. So when they first came to see me, their top goals, or what they wanted to achieve, was they were really, really keen on buying their first house. So they'd been renting for a number of years, and now with the two kids, they're ready to get out of the rental market and buy their first house. They wanted to get on top of their finances and have a bit of structure. So up until now, as I said, it was a little bit all over the place. They had Kim's business that was just getting started. So they had her expenses. Kanye's been running his business for a while, so he had his business expenses. Then they had their household expenses, which anyone listening with two kids, I'm sure you can imagine what's involved with that. So school fees and just kind of things everywhere. So they had a lot going on. So it was no surprise that their finances kind of took a back step, because they had everything else kind of to deal with. So things were a little bit messy. So they wanted to get on top of their finances and have a bit of structure so they could clearly see what was happening. They also explained to me that they wanted to start looking at some stage additional investment vehicles to grow their wealth. The way they explained that was maybe look at investment properties, or maybe start investing in shares, because they hadn't done anything like that before. So they know that's important. So they wanted to talk to me about that. Some of the biggest challenges and issues that they were facing, or what they told me, was they were starting fresh almost, that they had next to no investments in place yet. They had some bad debts. So they thought, because of their savings versus what they had in debts, that they were in relatively good financial position, and the fact that their businesses were now both starting to kind of start growing. So Kim's was starting to pick up a bit of pace. Kanye's was going well, so they feel like they're finally starting to earn some really good money. They want to make sure that they take advantage of this and have a plan in place to manage their finances, so that they can put themselves in the best financial position possible. I will put all this information in the show notes, or up on the website, which you can find at rossmarais.com/podcast. And I'll have all this information. So if you're interested, you can jump back and work through it and read through what the current financial position was. All right. So hopefully that gives you a good sense of what they're wanting to achieve and what their current financial position was when they first came to see me. What we helped them with, and what we did, was the first thing, we just clarified those goals that they told us they wanted to achieve. So we put some time frames around them, and we put some dollar amounts around those goals. So having a goal of buying a house is great. That's a great goal to have. However, we wanted to try and clarify that a bit more. So what does that actually mean? So we spent some time to just dig a little bit deeper of exactly what that looks like. So what type of house were they looking at buying? Did they want a unit? Did they want a townhouse? Did they want a 5-bedroom house on land? So what does that look like? So obviously that's going to be different from everyone. And in their case, they wanted a 4-bedroom house, not necessarily too worried about whether it was a townhouse or an actual standalone property, but they just wanted a 4-bedroom house that they could live in with obviously their two kids and be comfortable. And for them, what that looked like was buying something around about the $600,000 mark. Now, if you are listening to this right now, just to bear in mind, this was about 2 years ago that we worked through this. So property prices looked completely different 2 years ago, especially on the Gold Coast, to what they are right now in March 2021. So just bear that in mind. In their case, they were looking for a 4-bedroom house around about the $600,000 mark. So then we could start to get a sense of what that looked like. Now, one other thing that I probably should have mentioned was that they had already gone to a mortgage broker. So they had gone to a mortgage broker and said, look, we want to buy a house. We have $60,000 in savings. We think we're ready to buy a house. And what the mortgage broker explained to them was that while they do have the savings in place, they've also got this debt and they've also got this income problem. He didn't think at that stage that they were ready to buy their first house. So he suggested they come speak to me first. And that's how I got introduced to these clients. So they came to me from a mortgage broker with that goal instead of buying that house. So we were able to ascertain what that looked like in terms of the value of the house they were looking for. So then we could work back to say, okay, what type of deposit do we need to have in place to make that a reality? So we worked out that we wanted to have at least a minimum house deposit of about $50,000 to get us on track. And then that would put us in a position that we could make that goal of buying a house a bit more realistic at that stage. So we clarified that a bit more, and then we prioritized to say, okay, how important is this goal? When would you like to achieve it? So we agreed that within the next 12 to 18 months, that's when they would like to be able to buy their first home. So relatively short period of time in their case. So that was what we ascertained. So the next thing we looked at once we clarified those goals a bit more was their income position. So when we look at someone's income position or their income plan, we call it, is we want to look at what their income is. So what income is coming in at the moment. So if you're an employee, this is relatively easier because you get a paycheck each week or each fortnight or each month. For most people, that income's pretty consistent. However, when you're self-employed, and in this case, both Kim and Kanye are self-employed, it makes things a bit more difficult to know exactly what money's coming in. And this is why cash flow becomes so important in the business, or understanding your cash flow, because you've got income coming in at different times. In Kim's case, she was getting paid weekly for running her business. She was getting paid weekly, whereas Kanye, he was getting paid monthly, sometimes every 3 months. So the jobs that he was doing were only getting paid kind of every 3 months, which makes it quite hard to manage cash flow when things are that irregular. So why that becomes important, or why that becomes difficult, is because when you have weekly expenses coming out of your business and personal bank accounts every single week, but you're only getting paid every 3 months, it becomes hard to juggle. So we wanted to get as clear as possible what their income was. So we looked at what income they were generating in the business. We went back and looked at the last year's tax return to understand what that looked like. We clarified a bit more exactly how they get paid, what they charge, what they do in their businesses. And then we looked at their expenses. So we made a list of all their expenses, and to get a sense of what expenses were business expenses. So what expenses did Kim have in her business? What expenses did Kanye have in his business? And then what expenses did they have personally? So what school fees were they paying? What rent were they paying? What did they spend on groceries? What utilities? So phone, internet, electricity, petrol. What do they spend kind of as entertainment money? So going out, restaurants and dinners and that type of thing. By getting a sense of that, we could start to paint their financial picture. So we knew what their assets were. We knew what their debts were, but we didn't know what their income and expenses were. So that was the first step to understand their financial position and get clear on their income and expenses. We worked out when they first came to see us that they were spending about $9,000 a month in expenses. Just by going through that exercise, we were able to review some of the expenses they were paying and cut out any unnecessary things that weren't adding any value to their lives. So by doing that, we were able to reduce their expenses down to about $8,000 a month, which means it was we're now saving an additional $1,000 a month. So our savings are up to about $2,000 a month, which was a big jump in their case. The other thing we did was looked at ways that we could increase their income. Now, that's not always easy to do for everyone, especially if you are an employee. It's not easy that you can just increase your income. However, one of the benefits of being self-employed, running your own business, is that you get to set your own rates in most cases, or you get to set your own fees. So in their case, we're able to look at what they were previously charging, and we could then ascertain whether it was reasonable to increase their fees or increase their services, which in turn would increase their income. So in their case, we're able to do two things, which is really important. Sometimes we're only able to do one. Sometimes we're only able to increase their income, but we can't do anything about expenses. Other times for clients, we're able to reduce their expenses, but their income is fixed. So we're kind of locked there. However, in Kim and Kanye's case, we're able to do both. Not only were we able to increase their income, we're also able to reduce their expenses. So that really helped us. So we were able to increase that savings rate to about $2,000 per month. So from $1,000 to $2,000 per month, which was a big jump. We then looked at their current savings and their debt position, and we realized that we can't just take all their savings and pay off their debts and be left with nothing, or just be left kind of a little bit short. So we made sure that we left enough money in their business accounts to keep their businesses running. And then we also made sure that we had an emergency savings account of the savings that we did have. We put that aside to say, this is our emergency fund. We have 2 kids. We want to make sure that we have money saved, that if something did happen, we don't have to reach for a credit card or reach for a personal loan to pay for that emergency. So keep some money in business accounts, keep an emergency savings in place for their emergency fund. So once we got an understanding of their income plan, we got that under control, saved some money, put some money aside. We then looked at attacking their debt. So we had money left over, and we were able to, in their case, we were able to clear the debts that they had owing. So the $20,000 of debts that they had owing across a car loan, credit cards, and ATO debt, we were able to take the savings that we did have after keeping some aside for the emergency fund and the business funds, and then we were able to wipe their $20,000 debts. Now, obviously, that did reduce their savings. However, we know that the fastest way to increase in your savings is getting rid of any of the debt repayments that you have. So we're able to clear their debts, and then we were able to put the remaining money left over, which in their case, so we had $60,000. We kept money aside for emergency savings. So we kept about $20,000 aside. We paid off the debts of $20,000, $60,000 in savings, kept $20,000 aside, paid off the $20,000 in debt that we had owing, so we had left with $20,000. So this was a really big light bulb moment for Kim and Kanye. So when they first came to see me, they saw their bank accounts and had $60,000 in savings. So they thought in their position that they had $60,000 in savings, that they could put down a house deposit for $60,000. What they didn't necessarily realize was that their actual position was $20,000, because we had to have money set aside for emergencies. We had to pay off that debt, or we didn't have to, but it was the right thing to do, was to pay off that debt and just clean things up. So yes, we went back in savings, but we went back 2 steps to be able to take 4 steps forward. So kept the savings, cleared the debts, and then we had about $20,000 left over to start our house deposit goal of getting to that $50,000 mark in 18 months' time. The next thing we looked at was their insurance plan. So in their case, they no longer had much debt, but they still had 2 kids that they looked after. And being that they're both self-employed, if their income stops, it's going to cause trouble in financial lives. So we want to make sure that if the worst did happen, that they had suitable insurances in place. Not everyone, or I'll rephrase that, no one likes talking about insurance or paying for insurance, but it becomes really important when you have what we call dependents or children to care for. We reviewed what they had in place, and then we recommended we put in place suitable life insurance, disability, and income protection, just to make sure that they were fully insured, that if something did happen, that their family and their income and weren't going to be at risk. The next thing we did was we reviewed their current superannuation funds and made sure that they were invested correctly inside their super funds. Now, in their case, they didn't have much inside superannuation, which I said before, because they had been self-employed for the last 10 plus years, that they hadn't been contributing to their superannuation fund. However, it was important that we reviewed where their super funds were, where it was invested, and make sure that it was suitable for their personal financial position. And then we agreed and put in place a plan to make sure that starting next financial year, that we start contributing to superannuation, which is going to help to put them on track for that longer term goal that they had, which was additional investment vehicles to build their wealth. We also looked at their estate plan. So we agreed and put in place wills and estate planning documents, including, most importantly, a nominating a guardian. So a guardian is someone to look after your children, if you do have children, if the worst did happen. So if something happened to both Kim and Kanye, we nominated someone, so a friend or a family member, to make sure that their kids could be looked after in that case. So that's what we did. We reviewed their income plan, we looked at their debt plan, we looked at any insurances and what they needed there. We reviewed their superannuation, and as well as putting in place an estate plan and estate planning documents to make sure that themselves and their children were fully protected. As a result of working together, not only were we able to increase their savings by $1,000 per month, we were able to go from being $20,000 in debt to having $50,000 in savings and purchasing their first home within 18 months of working together, which was awesome. Some of the biggest lessons that we learned going through this process with Kim and Kanye, as I said at the start, not only from my position, but from their position as well, was helping them to understand for the very first time that not all money coming into your business is your money to keep. And this is something that not only Kim and Kanye struggled with, but I see a lot of other business owners struggling with as well, is that just because you earn $10,000 in your business doesn't mean you get to spend $10,000 personally. Unfortunately, it doesn't translate like that. By working together, what we're able to do and what they were able to learn through this process was that $10,000 coming into your business, we've got business expenses we need to pay for, we've got tax that we need to take out of that, and then what's left is yours to spend or keep in your personal accounts. So it was going through that process to helping them understand what that looks like. So knowing how much money that they need to keep in their business to make sure that keeps their business running, how much money that they need to be withholding in tax. So again, this is something that business owners or self-employed clients struggle with. If you've been an employee for a number of years, you don't necessarily have to worry about withholding tax or superannuation in that regard. So when you look at your pay slip, you've got super taken out, you've got your tax withheld for you by your by your employer, and you don't necessarily have to worry too much about it. However, when you're self-employed, that all falls on you. So you need to make sure that you're withholding the right amount of tax. You need to make sure that you're taking money out for superannuation. So you can start to see that $10,000 coming into your business in this example, once we take those things out, we're down to maybe $7,000 or $6,000, depending on your situation. That's your money. It's not the $10,000 that coming in. So this was the case with Kim and Kanye. They, for the first time, they're able to understand what was their business position, what was their business income, what was their business expenses, and what that looked like. So we're able to separate from having kind of everything bundled together in one or two accounts. We're able to separate Kim's expenses out. So we had a Kim's business bank account, we had a Kanye business bank account, and then we looked at their personal bank accounts as well. So we could clearly separate what was happening in each of those, what income we needed to keep, or what savings we needed to keep in each of those buckets to make sure that everything kept working. And then importantly, making sure that going forward, they were withholding the right amount of tax so that they didn't end up in the same position next financial year that they had tax bills to pay. So this was the first time in the last 10 years, Kanye was paying tax ahead of time and not having to have a tax debt at the end of the financial year once he had lodged his tax return. So that was a really good outcome. So just a quick recap on their position. As I've said, I'll put all this information on in the show notes and on the website so you can find out more about what we were able to do for them and what their financial position was. As I said before, we're able to increase their savings, we're able to put them on track, and we're eventually able to purchase a house within 18 months of working together. We're able to clearly separate their business and personal expenses so they could understand exactly what was happening in each of those buckets and feel like they're actually getting on top of their finances, which was one of their main goals, that when they came to see me, that they wanted to feel on top of their finance and have some structure in place so they could clearly see what was going on. As well as we made a plan to start contributing to superannuation, which was the first time they had done that in a very long time. So then that was helping to grow their wealth or grow their finances in the future. So I hope you found this episode helpful and informative. And just a little bit of a backstory of why I wanted to put these together was that I was getting a lot of questions from friends or prospective clients and just people, listeners in general, to say, well, what do you actually do as a financial planner? Like, I probably need some help with my money, but I'm not sure who should I talk to and what do you actually do? So I thought this might be helpful to show you exactly what a financial planner can help you with, whether that's working with me personally or working with another financial planner. Hopefully get a sense of what that might look like. And the other thing that I thought was helpful to go through this type of episode was that I've had the same thing. A few people kind of say to me that they never really know where they sit. So whether you're employed or self-employed, doesn't really matter. But because we don't talk about money at all, because it's still such a taboo topic in our society, no one really knows that if what they're doing is right, what they're doing is wrong, or how much income they're earning versus compared to someone else. Because our lives are so different, because everyone's financial positions are so different, it's hard to know whether you're on track or whether other people are doing things that you're doing. So hopefully by sharing these types of client scenarios with you, you can get a sense of what other people do, where other people are financially. And obviously everyone is different, everyone has different goals, but at least you start to get a sense of what other people may or may not be doing in their financial lives. So a couple of things before I let you go. If you have a money question that you want answered on the podcast, please be sure to follow the links below and ask or submit your question at rossmarais.com, and I'll be sure to answer your questions on a future episode. As well as if you need to chat to someone more about your personal financial position and want to have a confidential, complimentary chat with myself or my team, please head over to moretimefinancial.com/apply, and you can book in for a complimentary 30-minute chat and find out more about how we could potentially assist you or just helping you to make smarter decisions with your money. Hope you found that episode helpful. One last thing before I let you go. To follow along, to make sure you stay up to date with all future episodes, we do have our own Instagram now, so head over to Instagram, More Than Money AU. You can find us there. Follow us along and stay up to date with all future episodes. Hope you have a great week.
If you've enjoyed this episode of More Than Money, make sure that you subscribe to keep up to date with all of the latest episodes. And feel free to like, comment, and share with a friend.